been about 4 months now that Australia's property markets have been on the upturn, but there are multiple markets in Australia, each doing different things. So in today's episode of the Michael Yardney podcast, Dr. Andrew Wilson and I are going to unpack what's happening in the property market so you're a more informed investor. Now, this is the audio of the regular video program that I do with Andrew Wilson each week, and because of that we're going to discuss some graphs, but in the show notes there'll actually be a link where you can get a copy of all the graphs, you can see what's going on, but there's so much content you don't really need it, you can listen in. And it's not just data, we're going to give you our commentary so you have a better understanding of what's ahead. We're going to discuss the macroeconomic factors affecting the world and Australia's economy as well. Clearly, we've got to talk about the interest rate cut and what's ahead and what it will mean. We're going to talk about asking prices around Australia, auction clearance results, and I'm sure you're going to want to know what we believe is ahead for our property markets. Lots to discuss. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
Australia's housing markets have clearly turned the corner. The housing recovery in our two biggest cities, Melbourne and Sydney, gained pace with property prices increasing over the month. Buyers are back making plans. They're looking at properties. They're approaching their lenders for finance, and they're buoyed by falling interest rates and the prospect of maybe even another interest rate cut early next year. Sellers are slowly returning to the market, encouraged by rising prices. Now, this marks the 4th consecutive month of positive news in the property markets, particularly in Melbourne and Sydney, which took the brunt of the downturn over the last couple of years. And as a result, auction clearance rates are up, asking prices are up, property values are increasing, and some property commentators are even forecasting double-digit capital growth next year. Now, in previous Property Insider videos like we run every week with Dr. Andrew Wilson and myself, Dr. Wilson called a market bottom a few months ago. So to explain what's really going on in our markets and to give us his forecasts on what's ahead, let's have a chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Welcome, Andrew.
Thank you, Michael. Yes, and it has been another positive month for the housing market, and the data we'll talk about today certainly reinforces that. And we're well on the way to, I guess, recovering back to the levels we were at the previous peak, particularly in Melbourne and Sydney. But that's going to take, I believe, at least a year to fulfil those, I guess, predictions of a V-shaped recovery, whatever that is. But I think it means we get back to where we were.
Well, let's dig into the data. But before we do, and you've prepared a lot of data today, what I'd like to do is start with the big picture, the macro world. So there still have been interesting movements overseas. The US trade wars have continued on. Donald Trump's announced a raft of tariffs and the damaging war between the US and China, the trade war, is beginning to weigh on the world's biggest economies a little bit. The Brexit saga, that just continues on. And interest rates around the world are easing a little bit, trying to stimulate economic growth. That started with the Reserve Bank, the Federal Reserve, I should say, the United States. So we've got that as a bit of a background, Andrew.
Yes, Michael, it's been an interesting month in terms of the global economy. As you suggested, there is some turmoil, particularly in the UK regarding Brexit. I think we've oversold, to be quite honest, the impact of the tariff issues between the US and China in terms of its impact on the real economy. Make no mistake, however, it has an impact on sentiment. And I think what we're seeing largely reflecting that China-US issue is sentiment-driven rather than the real economy-driven. I mean, there is a readjustment here going on in trade between the US and China, and that's got a lot to do with the imbalance between the currencies there. That's really been a fork in particularly the US trade position with China, and that's to do with, I guess, that dirty float that China has been conducting over the last decade or so. So this is, I guess, in a way, a natural adjustment process through that, and we've seen some ramifications in terms of China's positioning its currency. But I think it'll work itself out eventually. But I do think the main point is that it's not having a significant effect on the real economy, but it is being used to blame for everything from the Australian economy to global warming. I guess will be the next thing is be blamed on the China-US trade war. I am being facetious there. But look, I do think, as I said, it's been a little bit oversold, the real impact. But make no mistake, rates are falling, as you suggested. There is more stimulus now being presented into global economies. And the US, of course, cut rates last month, second time for the year. And we've entered a rate cut cycle in the US now for the first time in 10 years. So that obviously is signalling again some concern over the direction of the global economy.
Well, obviously interest rates have been cut 3 times this year in Australia, and we'll get on to the reason behind that in a moment. But our GDP growth was poor. We've already discussed that in a previous Property Insider chat, where for the June quarter it was reported at only 0.5%. But remember, this is a lagging indicator and really reflects what happened before and around the time of the election, and things have changed considerably since then. Andrew, we still seem to be creating a lot of jobs. 34,700 jobs were created in August. We've been creating about 26,500 jobs every month since the start of the year. But we're seeing a record high participation rate, up to 66.2%. And that's causing our unemployment rate to lift a little bit. And that seems to be concerning the Reserve Bank.
Well, the Reserve Bank has pitched full employment, lower rates until they get full employment, whatever that is. They suggested we were at full employment a couple of years ago. So I guess it's somewhere with a 4 in front of it. I don't think they'll get there. I'm not sure where the jobs are going to come from. Participation rates are rising, Michael. We shouldn't be surprised at that, because low incomes growth obviously means that people are motivated to stay in the workforce or to re-enter the workforce, particularly older Australians. And that's the real conundrum here, that incomes aren't growing. And Reserve Bank is working towards, with that monetary policy, cut again rates, as you said, 3 times in 5 months. Extraordinary action by the Reserve Bank. It's certainly a remarkable U-turn from a year ago. Now, I don't believe it'll have any impact, particularly the impact the Reserve Bank is hoping. And all it does is really put our backs to the wall in terms of leverage in case we do get a global economic shock. It's time to switch to fiscal policy and time to really rethink the mantra of always remaining in a budget surplus and working towards that. And I'm not talking about spending on infrastructure per se. I'm not a great believer in that. And that typically is more of a state government issue, infrastructure spending. But there are other ways we can think outside the square to stimulate the economy through fiscal policy. And that's a challenge now for governments to try to find a solution to this moribund economy where we're just not seeing any life at all in terms of incomes or inflation.
Well, Andrew, call me sceptical, but I think that the Liberal National Party government is wanting to deliver that surplus. It wants to say, hey, look how good we are. And so rather than spending at the moment, it's retaining this surplus so it can come in next year's budget, say, hey, we've delivered what we said we would, and then getting closer to the election, maybe they're going to spend some of that money. Maybe that's just a cynical view, Andrew.
Well, it's like, look how good we are. We've got interest rates approaching zero and a budget surplus, but the economy is more or less in the dustbin. Incomes aren't growing, inflation won't rise, and everybody's pretty miserable. I mean, is this cloud cuckoo land? And are we just transfixed by these models of economic, I guess, fundamentals that have failed us over the last decade, really globally, not just in Australia?
One of the leading indicators we look at is dwelling approvals, and they've fallen for 21 months in a row now. And this is bringing dwelling approvals down to their lowest level since January 2013. That's an issue for stock for the future. It suggests that we're not going to be building enough stock for underlying demand of our increasing population of about 400,000 people a year. There's also an issue with regard to unemployment because the construction industry, particularly the high-rise construction industry, employed a lot of people, Andrew.
That's right, Michael. I mean, the Reserve Bank and APRA, in a sense, have shot themselves in the foot, over-managed risk and cracked the housing market. Of course, that stopped development, as you said, particularly high-rise residential development. The banks have also headed for the hills and are running scared in terms of lending still, again over managing risk. And the prospects are for an undersupply of property, no doubt about that, as you suggested. But the real issue is, where are the jobs going to come from? They were, it was very fertile ground post the end of the previous mining boom, was the boom in apartment construction, which was almost every capital city was involved there and created a lot of jobs, a lot of downstream economic activity. Now, that's going to disappear quite quickly. And you've got these issues with retail. Where are the jobs going to come from, Michael, that are going to create this sort of full employment model that lower interest rates are supposed to generate? This is now what the Reserve Bank, in a sense, is in between a rock and a hard place. But I'm sure it will ignore growing house prices now, realising that the main game is trying to get the economy growing again and unemployment falling.
One of the other things that was reported recently was housing credit growth that grew just 0.2% in August, as low transaction volumes and interest-only resets continued to drag on this. So this took our annual credit growth down to 3.1%, which is the lowest annual increase since records began in 1977. This is going to have an effect on the housing market and slow down the boom that some are predicting. Not you and me, but some are suggesting that we're going to have a boom. But you actually need money. You need credit. You need to be able to borrow to do that.
Those aggregates that come out, Michael, are interesting, but I prefer to wait for the ABS breakdowns that'll come through at the beginning or the first 2 weeks in the month to give a better feel of exactly where credit growth is or where it isn't.
Well, the elephant in the room is the interest rate cut. And recent evidence of a strong rebound in the Melbourne and Sydney property markets just wasn't enough to stave off that rate cut. Some people thought maybe the Reserve Bank would hold off a little bit longer, but the RBA cut official interest rates to 0.75% on October 1st, citing weaker than expected growth in our economy and global uncertainty. Andrew, I read RBA's statement and there were a couple of interesting things that stuck out to me, so maybe I could run them past you and get your thoughts. The Reserve Governor said the board took the decision to lower interest rates further to support employment and income growth. We've already discussed that, and to provide greater confidence that inflation will be consistent in the medium term. The other two things I'd like to quickly run past you and then get your thoughts are, it's reasonable to expect an extended period of low interest rates will be required in Australia to reach full employment and achieve the inflation target. I guess that tells us what's ahead. But what he then finally said was the board will continue to ease monetary policy further if needed to support sustained growth in the economy, full employment, and achieve inflation targets over time. I guess that tells us what's ahead, Andrew.
Well, more cuts, but what good will it do? I mean, if you can't get growth being generated at 0.75, is it going to be generated at zero? And there are a lot of very serious issues if we got to a zero interest rate. We should learn the lessons from overseas, of course, Michael. We start printing money to bring down long-term bond rates. This is just a perplexing environment now. The Reserve Bank is basically got tunnel vision in terms of its policy settings. It's down. We're going to keep going down until we get full employment and higher inflation and higher incomes. Well, here's a question. What if we don't get that? What if it just, as they've said, they've sort of created a never-ending narrative there where, well, we'll just wait and wait and wait and wait. How long is it going to take? When are we going to get the dividend from the lowest rates we've ever had by a mile that the Reserve Bank is speculating or promising us? It hasn't happened with the cut in interest rates we've had over the past 3 or 4 or 5 years. Why is it going to happen now? And we're also now facing the problems perhaps of a global economic downturn, which will only exacerbate issues in terms of employment growth. So there are a lot of problems here, Michael. I'm not sure these problems are going to be solved, as the Reserve Bank is a wishing and a hoping and a praying they'll be solved by cutting interest rates. It hasn't worked so far, and it, in my opinion, will not work going forward. And it's a bit of a cop-out to say eventually, and what does that mean? In 10 years' time, it'll finally work and they can then announce victory with low interest rates. Now, we've got to be a bit cleverer than this, and we've got to just loosen ourselves from the holds of economic dogma, and this dogma has certainly not worked for the results that Australians rely upon, and that's particularly to at least have a sense of the prospect of some prosperity in their working lives.
Well, interest rate cuts are likely to have a much smaller impact than when interest rates were higher. They seem to be at a historic lows at the moment, but so the banks aren't able to pass on the full rate cuts. That's already come out where they're not doing that. But at the same time, Andrew, it seems like Australians are stashing their cash. They're paying down their debt, and businesses seem hesitant to invest due to the uncertainty that we've spoken about in the global economic outlook, the Australian economic outlook. So I agree with you. It looks like the RBA is going to be challenged by its forecasts.
This is cloud cuckoo land stuff, Michael. The RBA, APRA and ASIC have all bemoaned the risk involved with high debt levels potentially or theoretically in the Australian economy, and they've scared the bejesus out of consumers to the extent where you're right. People aren't spending, they're saving because they're worried about all this commentary regarding particularly Australians' debt. Now, what do you do if you're in debt? If the government and the policymakers are telling you all about this debt, well, you obviously save and save. Now, and you're restricted with your saving anyway through low incomes. But if you're saving, you're not spending. Hello, what does that do to retail? What does that do to consumption? I mean, this is crazy stuff, Michael. The policy positions of 2 or 3 years ago have now come back to haunt the RBA, and they're really in a corner here. And as I said, it's one thing to be blaming the China-US trade war, to be blaming climate change or blaming whatever, the drought, for all these issues. But it has been, in my opinion, an over-management of risk, which has cracked the Australian economy to the point now where we're really in desperate straits and heading towards, God forbid, a 0% interest rate. So really some very hard questions here. But what we really need beyond the questions are some answers. And those answers aren't, in my opinion, just cut rates until something happens and then wait and wait and wait, hoping something will happen eventually. Not good enough, Michael.
Well, I agree with you. The government now needs to implement some reforms to drive long-term growth, but the rate cuts have had one impact. They've actually had an impact on our property markets, which are rising. So let's have a talk about that. The number of different data models showing that median prices have increased, particularly in Melbourne and Sydney, for the 4th month in a row. What are you finding with your asking price models?
Well, similar results, Michael. And of course, those monthly numbers do tend to bounce around a little bit, but asking prices have been more or less stable over September versus August. However, we did see, no surprise, a jump in the Sydney median asking price. These prices are mix adjusted. That means they account for the change in property mix values, so they don't tend to reflect on a change from period to period from higher price to lower price properties being listed for sale. But nonetheless, it's been a steady and a rising market other than a falling market, Michael. And I think we've got to understand when we talk about particularly the Melbourne and Sydney markets revitalising, that even though we're seeing prices growth now, we'll likely see maybe net 5% this year, that they're still 10% behind where they were 2 years ago, Michael. So those that are buying in the market in Melbourne and Sydney are still buying at a discount from 2017. So even though we shouldn't really be surprised that prices are rising in Melbourne and Sydney at a faster rate than other capital city markets generally, because they've got the most to catch up, because they were the markets that tanked. Melbourne and Sydney, unsurprisingly, given that they're still at a discount, are attracting buyers. Other markets such as Adelaide and Brisbane, for example, where their prices are around about their peak levels now, aren't seeing that same type of growth coming through. Now, they will grow. Low interest rates will ensure that. But we shouldn't be surprised that Melbourne and Sydney, particularly Sydney, which had the strongest growth, are now recovering at the strongest rate. But that's the word, Michael. They are recovering. They're not moving into another expansion cycle yet.
So that's reflected also in their auction clearance rates, and you've provided us a lot of data on this. So if we look at the first graph, it's showing the trend in Sydney, the weekend auction clearance rates, which have been just getting stronger and stronger. But now it's also based on slightly extra volumes. Sellers are coming back into the market, Andrew.
Yeah, look, both Melbourne and Sydney, Michael, look like they're peaking out at a very strong level. That 80% clearance rate is always a benchmark for prices growth. And, of course, we shouldn't be surprised that prices growth is occurring. We're seeing it not just in general models such as asking prices and sale prices, but we're also seeing median auction prices up over the year now in both Melbourne and Sydney, September this year versus September last year. Now, both Melbourne and Sydney are tracking as we can see on the trends, at around about that 80% clearance rate mark. I think that's really going to be the peak of that cycle. I don't think, typically history tells us it's very difficult to build a trend above 80%. I think 80% really is the peak of the market, because you've got to understand there are various areas. This is a capital city result, but there are areas that are doing considerably better than others. And those areas such as the inner east and outer east in Melbourne and the inner suburbs of Sydney, they're regularly getting clearance rates above 90%. Now, that's obviously reflects or is in contrast to outer suburban areas, particularly to the west in Sydney, and some of the outer suburbs in Melbourne to the southeast are getting much lower clearance rates. And so it balances out. But as I said, I think that what that tells us is that we tend to peak in the trend at around about 80% clearance rate. But that is very strong, Michael. And that means on a capital city level that will generate prices growth. And of course, that's what's happening. And we can see when we look back a year just how far the market has progressed in terms of the difference in clearance rates a year ago in September 2018 and now. And it's quite remarkable. And if we look at this year's September market versus last year's September market, we can see we're now seeing a revival in actual sales numbers. Sales values, that's the value of turnover, is also higher this September versus last September. What we are seeing, of course, is median prices are now higher in the auction market than where they were a year ago. And in Sydney, interestingly enough, Michael, listings are just about the same this year as they were last year. So as you suggested, listing numbers are starting to pick up again slowly. If we look at Melbourne by comparison, very similar result in terms of the numbers of sales and the value of sales. The median price has also increased for the first time on a month-on-month basis versus last year in Melbourne. But Melbourne's listings are still quite low compared to last year, Michael, down by 13.4%. So Sydney certainly the strongest market there in terms of the auction market. And we shouldn't be surprised that when we look at asking prices, that's also been the best result in terms of growth, over 2% over the month.
What we're hearing on the ground is sellers who want to upgrade their home or downsize are finding little stock. So they're a bit nervous about moving ahead. And they're thinking, well, the market's moving anyway, so why should I sell now when I can actually sell and make a bit more money in a couple of months' time or next year? Of course, what they're going to move into is going to cost them more as well. But I guess this is the conundrum. There's not enough stock on the market for this new wave of buyers.
Well, most buyers are sellers and sellers are buyers, and it's a process here. They can postpone their selling decision, but eventually, of course, personal factors will encourage sellers to get back into the market. It will happen. It's a slow process. We're seeing early signs of that now occurring. It is a cycle. It's a process, and we are starting to see what was quite a predictable rise now in seller numbers given strong clearance rates and higher house prices.
Now all we've got to wait for is the banks to be a little bit more friendly and make it a little bit easier to get finance, because that's still a bit of a hold-up.
Yeah, well, this is the over-management of risk. And again, we go back to the RBA and APRA that sort of scared the business out of the banks as well.
I thought you were going to use another B word, Andrew.
Well, then, very careful with my language, Michael. But I think that, as I said, it's one thing to crow about how fantastically risk managed our banking system is. But at the end of the day, if we're not lending in a reasonable risk environment, then there's no capacity for growth. It's not about speculative risk taking. It's about a managed and rational attitude towards risk. Now, we've thrown that out, Michael, with this crazy stuff that we've had in terms of high levels of debt, and we've got to create these benchmarks for risk management in our financial system. But what's happened, of course, is we've constrained growth and reasonable risk taking in terms of borrowing. And of course, banks have to do what they're told in a sense. And banks don't want to be accused of being risky lenders. So we've got to sort of unscramble this egg somehow, Michael. And when we are in, which is one of the positives of our housing market, an environment of high market power or significant market power from banks with the big four. It's a significant oligopoly. It's great because they can be more risk averse than risk inclined, which saves us from being risk inclined, which we would be if we could be. But you can overdo these things. And what it means is that if you have an overly managed risk system, it's one size fits all. And because we don't have a lot of competition outside the main banks, real competition, it means that we are constrained in this silly environment of constrained lending through over-management of risk, in my opinion.
Okay, now let's look at the rental markets, Andrew. So we've talked about what the housing markets are doing, but what's been happening to vacancy rates and what's been happening to asking rents? Let's start with the asking rents first, please.
Again, these monthly numbers can tend to jump around, particularly in the smaller markets. Sydney rents, of course, are now lower than where they were a year ago. They've certainly come off their highs, and we can see that validated by high vacancy rates. But Canberra, Darwin and Adelaide house rents fell over September versus August. We saw actually an increase in Canberra and Darwin unit rents. The Darwin market is a small market and that can tend to be volatile. There are a lot of properties, high vacancy rates in Darwin, and so that's coming off a low base. But Canberra certainly is a market where there are low vacancy rates, and we shouldn't be surprised to see rents continuing to rise for units in Canberra. Sydney still remains the most expensive place to rent a unit of all the capitals, and Canberra is the most expensive for houses. And at the other end of the scale, Michael, Perth is the most affordable for houses, having had a shakeout, as we know, in that rental market over the last 4 years. And Adelaide is the most affordable for units. Vacancy rates for houses and units in Sydney and Melbourne, interestingly enough, increased over September. We saw vacancy rates for houses and units in Perth fall. I think that's very interesting, Michael, that we're now certainly starting to see consolidated trend in downward vacancy rates in that Perth market, but it's being now correlated with some upward movement in rents in Perth as well. So I guess that we could certainly say that market has now sort of found its bottom. We saw vacancy rates for Canberra houses rise. Brisbane and Adelaide vacancy rates for houses were steady. Vacancy rates in the Darwin market fell. Those smaller markets do tend to bounce around month to month. Vacancy rates for units in Brisbane, Hobart and Darwin are also increased.
So putting all that together, Andrew, with another interest rate cut possibly coming next year with increased consumer confidence, and in fact, this week the ANZ Roy Morgan Consumer Confidence Index jumped again, but it's going up, it's going down, reflecting, I guess, what's happening in the news in the 24-hour news cycle. What do you see ahead for our property markets and for property values?
Well, the momentum is building, Michael, in our housing market. There's no doubt about that. And demand is certainly on the rise and supply is set to fall. And I mean overall supply or new supply. Going forward, we will obviously the trend, it's an easy one to pick now, Michael. You don't have to be a fortune teller to say the prices will continue to rise, particularly in Melbourne and Sydney. And with the almost promise of more interest rate cuts from the Reserve Bank, that will only fuel prices growth. Where prices in Melbourne and Sydney are still below their peaks, lending volumes are still below their peaks. So there's a lot of potential here. There's a lot of pent-up demand in our housing markets in terms of buying and selling that is yet to be released, particularly in Melbourne and Sydney. I still think it'll take the best part of a year to at least, and probably 2 years, for Melbourne and Sydney prices to reach their previous peaks. That's all things being equal, and that's the get out of jail card. But certainly there's no prospect of higher interest rates going forward here, which would be the only thing really that would tap out prices growth. And I do think that there'll be some sanity returning to the lending environment where banks will start to be a bit more realistic about lending practices. It doesn't mean opening the floodgates. It just means a bit more rationality. At the moment, we're seeing inner suburban higher priced areas do best in Melbourne and Sydney. Outer suburbs will start to catch up, but we know clearly the missing link in all of this are investors. And investors will start to get interested in the property market now that prices are rising. Again, they're at very low numbers. The question is, will the banks be interested in investors? And I think that's the key to getting the sort of growth we've had previously in up cycles. And I think that's why we won't get that level of growth going forward in the shorter term, because we have this constraint on investor lending
Well, I guess the rebound in housing conditions is going to help support an improvement in our economic conditions. Higher house prices tends to translate to people feeling better, feeling wealthier, feeling more confident, spending a little bit more, while the other effects happened over the last couple of years as the prices of values of people's houses went down. Not that they were selling, but it just messed up with their confidence and stopped them spending, and the wealth effect wasn't there. So basically, more green shoots ahead, and that's actually a good sign for the springtime, Andrew.
Well, it is, Michael. And look, to your point about the wealth effect, I think we're overstating that now, because the wealth effect has to be matched with the income effect. It's one thing to be asset rich, but if you're income poor, it's not good at all. And that's what we'll see. And that's why hopefully the Reserve Bank and APRA and all those that pull the levers, the federal government, will realise that it's about incomes. It's not about assets anymore. They were too much asset orientated in their policy settings a couple of years ago. Now they've got to get back to the main game, and that's trying to get incomes up and more money in people's pockets.
Lots of information. Thanks for providing all those graphs and all that data, Andrew. Look forward to catching up with you next week for our regular Property Insider chat.
Thanks, Mike.
Well, clearly we covered a lot today, but if you want to see the graphs in the show notes, there's going to be a link where you can get all the information, all the graphs. And remember, this was the audio of my regular weekly Property Insiders video I have with Dr. Andrew Wilson. If you'd like to get further information about that, subscribe to our Property Insiders YouTube channel, going to propertyinsiders.info, and you'll be updated each week as we discuss what's happening in our property markets and in the economy. And of course, in between the regular Michael Yardney podcast, I'd love you to keep up to date at propertyupdate.com.au, where you get daily commentary. Now, if you got some benefit from today, if you've got some friends who are wondering what's happening in the market and what to do, my aim is to educate as many people as possible to become more successful investors. And I'd like your aim to be much the same. So let somebody know about this. In every podcast app, there's a share button. Click it or just tell somebody about it. And if you want to tell the world, why not leave a review on iTunes, as Chicken Eye Productions did? Because when I read out your review and you email me at michael@metropole.com.au, I will give you one of my books. And this review, a 5-star review, thank you, by Chicken Eye Productions, said, "Hi, Michael. Really appreciate your wisdom and advice. I've started to put many of your success habits into place. I listen to your podcast during the day when I'm working, so I'm earning and learning at the same time. I only just started listening, so I've got many to get through, but if I'm honest, I'm really enjoying them. Thank you." Well, thank you for those lovely words, and I hope you're starting to become more financially fluent as you're learning. And by the way, a quick tip if you want to go to the back episodes of the podcast is listen to 1.5 times speed. That's how I tend to listen to podcasts anyway, and you can zoom through them much quicker. I'm going to be back again twice a week with the Michael Yardney podcast. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?